We're going to calculate the stock price for HP, and the first thing we need is the market cap, which is 21.65 billion, and then the stock price, which is 15.14. Now we know the shares outstanding. You take the market cap divided by the stock price, and you get 1.4 billion shares outstanding. So the way we calculate the value of a company is we estimate future free cash flows and then discount those numbers back to today's dollars. Then when we get the value of a company, we divide that by the shares outstanding to get a calculated stock price, and we'll compare it to the actual stock price. So now let's find out the actual cash flows. So we'll go to the finance section in Yahoo, go to cash flows, and then free cash flow. We'll put that into the model, and then we'll do net income. That's on the income statement. And we need 4 years of data for the model. And last is revenue. So always look at the numbers too, even if you're doing a model, just to see how they move and just to make sure there's no outliers. Everything looks pretty consistent, it's increasing, looks pretty good. Now we need to look at the capital structure of the company and figure out the discount rate we need to apply to the future cash flows. So the interest expense of $242 million is on the income statement, and that's the interest they pay on their debt. Now to find out the debt, we go to the balance sheet, we go to the liabilities, and current liabilities is the current debt. That's debt due within 12 months. And long-term liabilities is the liabilities due after 12 months. That's 4.8 billion. So they pay 4.7% interest on the debt. Interest payments are tax deductible. So let's get the effective tax rate. We'll go back to the income statement. Income before tax is okay, this won't work for 2019 because they show 2.5 billion of income but negative 629 million in taxes. So it looks like they got a tax rebate even though they made money, because the income statement doesn't just look at current year, it's looking at previous year's information too. So they may have had a loss in the prior year, or something happened. We don't know exactly. But let's just get a better read. Let's do 2016. The effective tax rate. It should be the same, pretty much same year to year, but when losses come in, that could change things a lot. So the effective tax rate is 29%. So the cost of debt is 3.3%, and they have 19% of debt in their capital structure, which isn't too bad. Now let's find the beta, which is the volatility of the stock, 1.05. So the stock moves with the market. And equity is the cost of equity is 10.4%, and we used a CAPM model to figure that out. And the cost of debt is 3.3%. So equity has a higher return than debt because equity is riskier. In the event of a default, debt holders are paid before equity holders. So for that added risk, equity holders require a higher return. Now we have the WACC, which is a blend of equity and debt. And the WACC is 9.03%. And this is what we're going to discount the future free cash flows by. And we calculated cash flows in year 1, 2, 3, and 4 of the future, and then a terminal value, which is all the years beyond year 4. We discounted those numbers back to today, and we get a value of the company of $58 billion. And when we divide that by 1.4 billion shares, we get a stock price of $41, even though it's trading at $15. So this isn't considered a buy. It's trading at a 63% discount, and it looks like it was never really even trading in the 40s. The highest was almost 30. Now it seems to be trading at a pretty steep discount. But stocks can always trade higher or lower than intrinsic value. The stock price moves on the demand of the market. If people think the price is going to go up, then they buy the stock and they bid the price higher and higher. If people think the price is going to go down, then more people are selling the stock and they push the price down. So everybody has their own expectations on the future. That's what makes it so interesting in the stock market. And we all have our own opinions on things and our own ideas on this stock, but this is my model and my opinion. So thanks for watching.